I've been very looking forward to this. I've got Lance Roberts with me. Welcome back to the show, Lance. He's realinvestmentadvice.com, the Lance Roberts Show, Real Investment Hour, all sorts of things. He's a busy guy, and I'm glad he finds time for us right here on Money Talks. Lance, nice to have you again.
Hey, I would never miss being here, Mike. I appreciate it.
Well, that's great stuff. Hey, we were talking just a bit with Michael Levy and then with Drew Zimmerman about I'm trying to get people to understand there's been a change in the bond market in the U.S. I mean, that 35-year bull market looks like it's over. First, let me get your take on that. Am I being premature in saying that?
Well, I think you're being premature, and let me just say why. Is that, first of all, for all the angst over the bond market, interest rates are now only back to where we were, guess what, at the beginning of this year. So,
yeah.
It seems like it's been a big decline in bonds, and it has been. I'm not going to deny that at all. It's down 13%. But, remember that interest rates were about where they are now back at the beginning of this year. We sold off going into Brexit because, Brexit was supposed to be the end of the known world as we had it. And, of course, that rush into those bonds were then reversed. And part of that is also occurring with a big devaluation in the Chinese yuan and currency restabilizations. Remember, currency balances off against the U.S. bonds. So if I need to sanitize transactions or stabilize my currency, I buy U.S. bonds. And so we're seeing some rebalancing, the post-Brexit and now the post-Trexit world when you look at the election of Donald Trump. Is the 30-year bond market over with? I doubt that. I suspect that we'll see 2% interest rates before we see 3% interest rates in the 10-year.
That's very interesting. And so do you have a signpost on that? I love your point and I knew it, that we're back to where we were, at the beginning of the year with the interest rates, but albeit it's been a huge jump since July. And because I think this is a key thing for everybody, whether they think of themselves as investors or traders, or they just think that stuff doesn't have a lot to do with you. You got to get the interest rate things right. In our case as Canadians, we got to get the U.S. dollar thing right, and I'll ask you about that in a minute.
Yep.
So what kind of signs are you looking for to say, okay, it may take years to unfold, but it looks like that bottom's in the rates?
Well, so if we go back and let's look at the function of interest rates for a moment, and of course everybody's focusing on bonds right now in terms of the great rotation and as an investment vehicle, and I certainly understand that we're getting a push up in stocks, and the portfolio managers or investors are jumping out of bonds to go buy stocks on the expectation that we're going to have this tremendous economic growth in the United States over the course of the next 4 years because of the policies of the new Trump administration. We can address that in a minute. But the reality is that interest rates are a function of borrowing cost, economic growth, and that's the key one, and ultimately long-term projections on real inflation, what's really going on in terms of pricing power, not just inflationary increases due to rising healthcare costs and rents. So the long-term trend in economics is to a slower rate of economic growth due to the structural shift in employment, the demographical shift of the U.S. as well as the rest of the world. We have a huge aging demographic that's dragging on growth, and particularly as baby boomers move out of the accumulation phase of their life into the distribution phase of their life, the impact will be for a net detraction on economic growth. So, and then lastly, of course, the carrier deal, I thought with Trump was a prime example of what we're talking about here. Everybody was excited about the tax cuts the tax credits being given to carrier to keep jobs here, but the CEO of the company said specifically, and this was his quote, he said, yes, we're going to keep jobs here. We're still going to move 1,300 jobs to Mexico because of lower cost of labor and a 1% absentee rate. They have a much more dedicated workforce at a lower cost outside of the U.S. He says we'll be investing $16 million into the Indianapolis plant, the plant that was saved, in order to automate the plant and reduce jobs in the future. And that automation problem is the long-term problem of economic growth, and interest rates cannot detach themselves from economic growth long-term because they are part and parcel of the same thing. I know that's a lot, but it's important to focus on.
Well, a couple of things, by the way, in that carrier story that you've just alluded to, I thought were really noteworthy. One, the 1% absentee rate. When I read that, I went, wow, that is telling. I mean, they will go wherever it's productive to go. So absenteeism is a problem. It's a problem in our government, by the way, a federal government. But, that's a big part of the story. The other, and this is where I thought Mr. Trump, I don't know if he doesn't have a clue or what it is, but the biggest problem was never trade with China. It was automation of those blue-collar manufacturing jobs, and that isn't stopping anytime. And, I just thought, so he can, all the bombast aside, it's not going to change. Every Western country's got a problem with technological substitution, and the manufacturing industry seems to be up front on that one.
Absolutely. And from an investment standpoint, I'm actually writing this in this weekend's newsletter. The newsletter on the realinvestmentadvice.com website. Sorry, shameless plug. It'll be out later on today. I actually have graphs comparing 1998 going into the bubble of 2000 versus today. And what you see there is rising interest rates, rising inflation, a market melt-up, exactly what you see today on this idea that economic growth is going to expand forever. We have the exact same outlook today. After an 8-year economic growth cycle, billions of dollars put into the U.S. economy through stimulus. The expectation now is, because we've changed a president, that we're going to extend and move into the longest economic growth cycle ever in the history of the United States. The reality is that rising interest rates, rising inflation is what ultimately pops the stock market bubble, and it's only a question of time.
It's interesting. This is where I'm weird, Lance, because I love the economic side of this stuff. But, I was just looking at a chart on the actual real costs of Obamacare, how they're going up this year, depending on the state you live in. But it's really significant. Well, that's, again, another example of money just getting taken out of people's pockets. That's not how you grow an economy. Out in Vancouver, for example, I saw that the municipal government wants to raise property taxes by nearly 4% this year. Again, money out. You got to look at the cumulative impact. But I just don't see any robust growth coming out of a political environment like this, where it still is high tax, although Mr. Trump is talking about a dramatic drop in business taxes, which may be very effective for their economy. But, it's just an interesting mix. There's so many variables involved.
It is. And when you have inflationary pressures driven by rising healthcare costs, and this is to your point, rising healthcare costs, which just extracts capital from the consumer, and from higher rents, which is an extraction of capital from the consumer. That's a very different type of inflation than price inflation in terms of prices moving up on goods and services because of consumer demand, when demand is what drives employment growth and economic growth. So as demand increases, companies go out and expend money to expand capital and production and employment, which leads to higher wages, which leads to more consumption and stronger economic growth, and it's a self-fulfilling cycle. The problem is tax cuts under the Trump administration, tax repatriation, in other words, bringing cash back from overseas, and deregulation are all great from the standpoint that it boosts corporate profits, but it does not lead to the one thing that increases economic growth, which is consumer demand.
I'm talking with Lance Roberts. You can find him at realinvestmentadvice.com. You heard him. He's got a new newsletter. You can just tap into that later on today. He's doing our interview. He's got to keep writing. He's going to put it up on the site, but I think you'll enjoy that this weekend. But, okay, so we've talked a little bit about their economy, talked about their bond market. I'll take a break, come back. I'm going to ask him specifically about this massive stock market rally that was unreal on Wednesday, I think it was, at 260-plus points. I'll talk with Lance about that right here on the Money Talks Network. Coming up, I'm going to share with you the 3 goofies that we're vying for Goofy of the Week. And then, of course, I'll say which one won out. You can decide which one should have won out. I'll do that before we're done today. But right now, I've got Lance Roberts, realinvestmentadvice.com, also, of course, host of the Lance Roberts Show. We didn't need a detective to figure out that Lance was probably host of a show named after him, but the Lance Roberts Show. Lance, we were just talking about the bond market. Let me just shift quickly. It's related, obviously, to the stock market. Just give me your first blush on the so-called Trump rally.
Well, it's an interesting byline, though, to everything we just talked about, whether it's inflation or whether it's interest rates, because the assumption now is that simply because that we elected a new guy to be president, that the last 8 years, of which was touted as supposedly great economic growth under the Obama administration, apparently sucked, because now, we've elected Trump, so all those bad times are now over, and this is going to be fantastic, and we're going to have all these tax cuts, and we're going to create all these jobs. But wait a minute, we have 4.6% unemployment. It's all a story. This is what is happening right now is a rotation in assets. Portfolio managers are moving in, trying to move into a risk trade. This idea that this economic recovery is about to finally lift off. And by the way, as just a sideline to this is the same thing we have every year at the end of the year, which is the expectation that we're going to have this great economic growth in the next year, which never actually materializes. But hey, it's hope nonetheless. But what you're seeing here is this rotation into financials. The reason is that Donald Trump is going to repeal Dodd-Frank. This will allow the banks to go back to the Wild West that led up to the bubble in 2007. That the deregulation of the economy and a focus on energy is going to be fantastic because this is going to allow for oil prices to return back to $100 plus a barrel, despite the fact that we have more supply and declining world demand. And that higher interest rates and a stronger dollar is going to be fantastic because this is to promote more economic growth, even though interest rates and stronger dollars drive to the very heart of the consumer and our emerging market and export consumers, which make up 40% of corporate profits. You tell me, does this look like something that is a sustainable rally long term when you look at the actual economic backdrop?
Yeah, it is fascinating, though, as you say. A lot of it is there's a new sheriff in town with different policies. I was wondering if a lot of this wasn't coming out of, as you said just before the break, he said, stuff that's good for the stock market or corporate profits doesn't translate necessarily to economic growth and the job issues that we've been discussing. And I just looking at that, if he does have sort of this one-time drop corporate rates to 10% or drop them down to 15%, if that's not what the market's looking at, I mean, if you're going to talk about...
Yeah, no, you're absolutely right. That's exactly what they're looking at, and where they're repricing stocks on the expectation that we're going to have this massive surge in economic and earnings growth over the next year. You're absolutely correct about that.
I'm also looking internationally that, I mean, it's always who's got the ugliest sister kind of thing. It's a comparative deal, and... why would you want to be anywhere else but the States if you're a European? I mean, it's the old, we can name the problems in the States, but they're nothing like what I see going on in Europe, especially that Italian referendum. So I sort of thought, money coming back into the States, and obviously some of it must be finding its way into the stock market too.
Well, it is, absolutely. And, the one thing to look at here is that we still have the ECB doing quantitative easing. We still have Bank of Japan doing quantitative easing. And one thing to consider is, and I wrote this a couple of weeks ago, actually last Tuesday in my daily blog post, is that for every dollar's worth of fiscal stimulus that we're going to get through tax cuts or tax regulation or regulatory reform is likely to be offset by the contraction of monetary policy as the ECB starts to wind down their QE, which they talked about. They went from 80 billion to 60 billion euros. They did extend from 6 to 9 months, but they are reducing that, so they're beginning to taper. The Federal Reserve is out. They're talking about tightening monetary policy, yet interest rates and LIBOR going up and a stronger dollar all tighten monetary policy. So they're front-running the Fed. So we're getting tighter monetary policy at a time that we're going to get some looser regulatory fiscal policy, which may just wind up being an offset from one another. So I think there's a lot of assumptions being built into the market that may not actually come to fruition. And if we take a look at the extent, now let's just talk some technicals real quick. If you take a look at the extension of the markets on a daily, weekly, monthly, or quarterly basis, the only times that we have been this extended on a technical basis has been at the peak of major markets. And this looks like very similar to the melt-up that we had in 99. It looks like the last leg push-up that we had in 2007, 2008. This has a lot of similarities to the melt-up phase, which is the last leg of a bull market.
Let me just come very quickly. We only got a couple of minutes, so let's get down to the individual investor. I know this is absolutely broad-based. It's sort of a guideline style of question, but just as broad advice, what are you telling individual investors to do on realinvestmentadvice.com?
Well, it's a great question. Thank you. Yeah, every week in the newsletter, I specifically focus on these things as it relates to the individual investor. And right now, the recommendation is to look at your portfolio, look at areas within your portfolio that have gotten egregiously overbought. That would be financials, that would be industrials, that would be basic materials. That would be these things that have been leading this charge over the course of the last few weeks. It's time to take some profits. Now, that doesn't mean sell the entire position and go run into cash. It means if your normal portfolio weighting in financials, as an example, is 5%, and they're now 8% of your portfolio, well, just sell it back down to 5, take some money, and set that off into cash and wait for a better opportunity to reinvest. In other words, just manage the risk of the portfolio. Personally, we're also within our portfolio management services, we're buying in the things that are the most hated assets. The best opportunities come from areas that people hate the most. Where would that be? That would be in financials. That would be in real estate. That would be in the things that are interest rate related, like staples and utilities. Those are the most hated asset classes because of this idea that interest rates have just ended their 30-year bull market. I'm telling you, they haven't. And when we get the rotation trade in the market from risk back to safety, and that will occur, when that occurs, those interest rate related assets are going to be a very beneficial part of your portfolio.
This is great stuff, and I want to remind people, realinvestmentadvice.com. Lance is going to post his latest newsletter later on today, so you can have a look at it, at your leisure there, because there's so much stuff going on, as you can certainly tell. Lance, I want to thank you again for finding time for us here. Great stuff.
Yeah, absolutely. Anytime. Nice talking to you.
Lance Roberts, realinvestmentadvice.com.